I'm Charlotte McLeod with the Investing News Network, and you're about to watch part one of my latest interview with Adrian Day, president of Adrian Day Asset Management. Part one covers what could be next for gold and how that relates to what's happening economically. We hope you enjoy. I'm Charlotte McLeod with the Investing News Network, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thanks so much for being with me online today.
Well, thank you very much for having me, Charlotte.
Great. So we haven't had a chance to talk to you, I don't think, since PDAC, and that was when we were really starting to see how the coronavirus might impact the global economy and the mining space more specifically. So to start off, I wanted to ask for your take on how gold has performed during this time, and I guess if it's done what you would expect it to do during a time like this, although it is quite unprecedented.
Yeah, well, I think in terms of direction, it's certainly done what I expected. You know, the sharp decline at the beginning, in the middle of March, and then a sharp rally. That's certainly expected, and we normally see that in sort of crisis situations and in sharp market sell-offs. You go back to 2008, or even go back before that. So that's a typical pattern. So gold sells off in a broad market sell-off, and it does it, as I think everybody knows. People are always surprised, why did gold fall? And sometimes it falls more than the stocks, or the gold stocks certainly fall more than the broad market. But it's because people want liquidity, and gold is the ultimate source of liquidity. And so you always see in a sell-off that, well, I won't mention names, but the big cap miners always fall more than the tiny juniors, because if you're looking for liquidity, you can't get it in the tiny juniors. Gold also recovered, and it recovered first, and that's also typical. In 2008, I've got a graph if we have time, but in 2008, gold recovered, and the gold stocks recovered before the broad market. And in fact, by the time the broad market had bottomed 6 months later, gold stocks had already more than doubled. So the direction certainly what I would have expected. I'll be honest, I'm surprised that gold and the major gold stocks have rallied so far without a correction. I'm also surprised that the broad market has done as well as it has. Most, not all of it has. Some of it is still down. I can think of some that are down, 40% from their February highs. But certainly the S&P in general has recovered very well. So, yeah.
Yeah, that feeds into my next question, which is we are hearing that we could be entering a global recession, or we could see recessions in specific countries around the world. At the same time, we have governments really doing their best to prop up their economies. So what's your take on the world's economic health right now? I know that's an extremely broad question, but let's see what we can do.
Well, that's awfully broad, as you say. Yeah, I mean, a few things. One is, I think, clearly we've got economies and certain sectors of the economy. So GDP, very weak. Unemployment, very, very high. Employment, very, very weak. And I think the truth is, when you look around, a lot of businesses are probably not going to make it. They're not going to recover. You think of restaurants, you think of businesses like restaurants, for example, which work on slim margins to begin with. They've been shut down in many places. I'm in Puerto Rico. They've been shut down for 2 months. And in 2 months, I can tell you the landlords are saying, don't worry about the rent this month. Don't worry about the rent this month. But once the restaurant's open, that's not a forgiveness. They're going to want the back rent paid. Most restaurants, they've laid off people. If they had, a small restaurant with 12 people, they might try and open with 8 people or 7 people. So all of these things have ripple effects. And when the restaurant opens, if they're only allowed to open at 50% capacity, as it is in many places, most restaurants simply cannot make it on 50% capacity, especially, if they have a 9 p.m. curfew, or something like that. So restaurants is just one example, but you could look at many stores, clothing, for example. They've been shut down for 2 months. They still have to pay the rent when they reopen. It's only it's not a forgiveness. It's just a temporary thing. So I think a lot of these businesses will either work on slim margins or were struggling to begin with, mall set competition and so on. They're going to have a very difficult time coming back.
Right. And the reason I ask such a broad question is because I think investors hear a lot of the time, like, if the economy is bad, it's going to be good for gold. And that's just a big piece of information to deal with. And I'm not sure people know what to do with that right now. So maybe there's something you can tell us.
Yeah, I would say that a bad economy or recession is not good for gold, because people need money to buy gold. But
That's right.
what is good, and a lot of gold demand comes from jewelry. Let's not forget that. So typically recessions, bad economies are not good for gold. What is good for gold is a crisis situation. So if you have a monetary crisis, which often comes with a weak economy, then that is good for gold. But it's not the bad economy that's causing people to buy gold. It's the monetary crisis and the uncertainty that's causing people to buy gold. I mean, I think gold is going to continue to do very well. There's a big debate: do we have deflation, or are we going to head into inflation? And I suspect that we're going to have a sort of deflationary period. I wouldn't call it deflation, but a deflationary period for a few months, and then we're going to see inflation by this time next year. So a lot of reasons for that, huge subject. But I'm not worried about a deflation and gold. A lot of people say, oh, if we have a deflation, that'll be bad for gold. No, not at all. Deflations are actually positive for gold. Gold does well in deflations so long as it's instability. It's the instability, whether it's inflation or deflation, it's the instability that causes gold to do well.
Okay, I think those are a lot of good distinctions that should be helpful for people. I wondered if you have any idea on where the price might go as we continue, because I watched your previous interview with us in PDAC, and I think you're suggesting maybe 1750 per ounce by the end of the year, which we have made it there. So I wondered if there's any update.
I'm certainly not going to hope that gold doesn't go any higher, just so I can be correct. No, how high is it going to go? It's definitely going to go higher, in my view. So that's a simple one. It's going to go higher. How much higher? I mean, a lot depends on what evolves. And looking at where we are now, looking at where other economies are, where the central bank is, where the economy likely is, I mean, I would say meaningfully higher. I wouldn't be at all surprised if we had new all-time highs this year. 2,000, 2,200 is a relatively conservative estimate for next year, I would think. So I'm very, very bullish on gold. Because what's happened is it's the monetary policy, if you can call it policy, I'll put air quotes around policy. It's the monetary policy being pursued by the Fed and by central banks around the world. Even Canada's talking about maybe negative rates now, maybe. But all central banks, pretty much every central bank around the world, is pursuing this QE infinity. And that is exceptionally bullish for gold, because it's basically a sign from the central banks that they're defeated. Central banks, we had in the US, we had TARP, and we had QE1, QE2, QE3, and then the Fed said they were going to tighten and normalize. They were going to raise interest rates, and they were going to normalize rates and normalize the balance sheet. Well, the balance sheet hardly budged downwards. I mean, you can look back over a 15-year graph or 12-year graph, and you hardly see any movement downwards. And interest rates, of course, inched up 2 or 3 times in the US, didn't move up at all in Japan, and now they're just down again. So the central banks have been defeated. And with QE, they have, I mean, with the new policy, QE infinity, they have admitted that they're basically defeated. And it's basically just, it's not a well thought out policy. There's no thought as to what the unintended consequences of this are. There's no thought to how do we eventually get out of it. It's just, oh dear, we've got a crisis, let's throw money at it. It's a big crisis, so let's throw a lot of money at it.
Right. I've been asking people, and I guess I'll ask you now too, how do these governments come out of it? Is there a clear path? It sounds like they at least don't know what that might be.
Well, there's sort of governments in the sense of administrations, and there's governments in the sense of the central banks. I am, right. So we'll talk about central banks first. I am extremely cynical about the central banks. As I say, in 2014, right, that was 6 years after the credit crisis of 2008. In 2014, the Federal Reserve said they were going to normalize. It was 2.5 years after that before they had their first interest rate hike, and they never did start selling off bonds. They simply stopped reinvesting the bonds that matured, but they never actually net sold. They just stopped reinvesting. And then after, what, a year and a half, that was all abandoned. And let's not forget, monetary policy was going back up again. You know, the balance sheet was increasing, and monetary policy was getting easier well before Corona hit. In the US, it started back last September when we had the overnight repo crisis. And the Fed started pumping money back in at a rate that at the time was faster than I'd ever done before in history. It was faster than 2008. So monetary policy was already loose. So anyway, the central bankers, in my mind, have absolutely no idea how they're going to get out of this. And I don't think they don't even have a subcommittee somewhere sort of considering, you know, what happens when. You know, governments, I don't know. You know, clearly when you've you know, increased unemployment pay, extended unemployment pay, sent checks once, now a second time in the US, in UK, people who aren't working are getting paid 80% of their normal salary. That's difficult to cut back on, because certainly, let's take the US, for example. You know, if you're saying, well, we're going to extend unemployment pay, because in the US, unemployment pay has a deadline. You know, I don't know what it is, but if you haven't found a job after X number of months, you stop getting the unemployment. But that's been you know, canceled during Corona. It's been extended and extended. So if come August, September, when it's meant to run out, and the economy hasn't still fully opened, are they really going to say, you know what? We said it would run out in September. Sorry, you don't have jobs, but no more unemployment. No, of course not. So I think these things are just going to continue for a long period of time until the economy gets significantly improved. Now, a lot depends on whether whether Congress becomes Democratic or Republican fully Republican or fully Democratic in the fall elections, because obviously the Democrats will be more willing to you know, extend and put more money in. But I just don't think the government is going to suddenly say, well, it's September, it's all over, you know, you're on your own now. It's just not going to happen. I also think we're heading towards what I'll call a selective debt jubilee. And you can see how the government has already said, well, you don't have to pay any interest on student loans this month. We've extended that. Oh, we've extended that another few months. Don't worry about it. Again, I think we're moving to a point when a lot of the government is going to insist that a lot of debts are simply forgiven or written down, or, you know, whatever. Are they really going to say to students, are they really going to say to people who have student debt in September, well, you had 6 months of not paying interest, but hey, now we want that 6 months interest. No, of course not. It's going to be written off. So I think we're going to see more and more and more of that. There's already pressure for landlords, residential landlords, to forgive the debt, forgive the rent for the time that the lockdowns existed. So, yeah, I mean, I think we're heading into a period of far more sort of interference in the economy, if you like, far more socialism, and far more interference in the economic decisions by the government. I mean, the truth is, I don't know, the vast majority of people I know, and not just people, but the banks in the US were saying, hey, when you open the website, the first thing you see is, hey, if you're having difficulty making your payment because of COVID, don't worry about it, give us a call. Now, they're not doing that out of the goodness of their hearts because they're nice people. Well, they may be or maybe not, but, institutions are doing that. Insurance companies were doing that. If you can't pay your bill this month, don't worry about it. And again, landlords. I mean, landlords were saying you didn't have to pay your rent this month. You don't have to pay your rent next month. So I mean, people were doing that kind of thing anyway. But I don't think any of these people were expecting to forgive that debt. They were expecting to get it back at some point. The credit card payments that you didn't make in March, April, May, they were just being added to your balance. So you were paying more in interest in the long run. So yeah, I'm very, very cynical about what's happening.
Thanks for watching part 1 of my interview with Adrian Day. Click below for the link to part 2, which covers strategies for investors in the current environment and recent trends like M&A activity.